Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, May 1st, 2018. Waiting for the markets really to get Apple's earnings out of the way today, so I haven't done any other updates because anything I post now on the charts is likely to change after the close today with Apple reporting. So before the close, I will post an update of how the charts look now and what to look for both on the broad markets and Apple. But the point of this video, I've been combing through sectors. I had a price alert trigger on one stock today in the aerospace and defense sector, which prompted me to look at the rest of the charts. And bottom line is I see a sector that looks to be heading considerably lower in the coming weeks to months. So looking at a swing short op here, there's three ETFs. PPA is one of them. Just show you the charts. They're all going to look similar because these are the same ETFs holding, for the most part, give or take, the same basket of stocks, of course, in different percentages, and may have a few different, some of the holdings might be a little bit different, but there's a few main aerospace and defense stocks like Boeing, United Technologies. We'll look at those real quick on the charts. This will be a brief video. But we're starting out here with a 4-year chart of PPA. It's a 2-day period. Each candle's 2 days. That allows me on this limitation in this charting program. You can only go back 2 years on a daily chart, but it's going to be the same difference. Basically, we have a trend line, very well defined. This is the first break. That trend line comes off the early 2016 lows. You've probably heard me say that a lot recently, covering different sectors, including the stock market. There's a common theme. These trend lines generated off on many sectors and the broad markets, like the S&P 500, off the early 2016 lows. And so what I take from that, these are very significant trend lines. They're over almost 2.5 years in the making, or well over 2 years in the making now. In this case, PPA, it has not had this is a 2-day period chart. So you see that breakdown there was an intra period, meaning 1 day, but then we shot back up and closed the candle below. Now we've broken down. So the story is going to be the same. This is PowerShare's version of it, PPA. There's the negative divergence at the high, everything I like to look for. The other ones are XAR, which is the Spiders S&P Aerospace and Defense ETF. And you can see same story. We're also on a 2-day period chart, so I can go back to those 2016 lows. There's a big flash crash candle there in the sector, so we have to move that off the chart, or it kind of skews it. When you see a super long candle like that, and you see it on more than one ETF, there was probably a flash crash in one of the components, and which caused that. So let's just ignore it. There it is. There's a trend line again, little brief spike down there below, but now we've clearly moved below it, challenging the 100-day moving average, which is the same as a 200-day moving average on a daily chart, negative divergence, and then finally ITA, and we'll look at this, and then we'll drill down the components. ITA, let's see, there's one version of the trend line I have on a daily chart showing a rising wedge. Again, same story, divergent high. The most recent high was a divergent high. And if we want to flip over to 2-day, that is a 2-day period chart, I'm sorry. We can take this trend line. I try to give you some levels there in case you decide to go with this ITA. There it is. There's the trend line. I should have had it drawn like that, down to the early 2016 lows like the others. And we've broken it. Now, there is some support here. That swoon down we had on all three of those ETFs occurred back here in early February when the market took it on the chin. So we're coming up to test those lows. So right now, I wanted to point these out for twofold. Number one, anybody who's in this and any investors that have a lot of defense stocks, I want to say now that I think the sector is looking clearly bearish. These breakdowns, are pretty well intact at this point. So at best, maybe a little bounce off this 183.63 level, possibly a back test if the market can really go on to make new highs. Back tests can occur at much higher levels. If we went to back test, it could take weeks and it could be another 7% or so higher. But I'm also looking to see if the indicators that PPO crosses down below the zero line, to help confirm a trend. Here's what it looks like on the daily chart, guys. Negative divergences, and this is a regular, every candlestick is one day's price action. There's that 183.63 level. You can see it was there was quite a few reactions right here. So it was resistance, then we broke it, and it acted as support. And that's why I'm not adding this right now, because the downside is limited till we hit that support, and we'll probably have at least a reaction on the next tag. It's only 2% below. However, there's a lot of thin air. I'm looking at the volume price histogram. I don't know if you can make it out here. I'll turn it up for you. And that helps to show you where the thin zones are. In other words, you can see these bars here. There's a lot of trading in this area right there, and pretty thin below. So this is what I refer to as a thin zone down below. Not a lot of trades occurred there. You can see it was a pretty swift, relatively unidirectional move up. So thin zones on volume price histograms work a lot like gaps. In fact, if you have a gap, you'll probably have a thin zone there, and that means once they're entered, they're usually backfilled. So there's considerable downside, and ultimately I think these levels down here, 140.35, 131.30 is where ITA is headed. At some point in 2018, possibly beyond, that's about a 25% to 30% drop in the sector. So pretty significant. And again, we can look at it one of two ways. If you are currently long the defense stocks, and I'll just go over a handful of those right now to help support the case that I'm making. I'll never go long or short an ETF or a sector based on how that ETF looks. I'll always drill down, look at the top components, and make sure they confirm as well. Because if you have even just a handful of the largest components in that sector that are coming up on support right after the sector ETF has given you a sell signal, well, if those leading components find support there and rally, then that will most likely lead to a false breakdown in the actual sector. So let's look at these charts. Let's go out long term to really paint a bigger picture here. We can go out, since most of these stocks have been around for decades. We'll look at the very long term charts. This is Boeing. This is the largest in the sector, a $200 billion company. And you can see here, I haven't marked this chart up. I should have done that. But the same trend lines. We'll get down to a weekly chart here in a second. And you'll see that, over the years, like all stocks, it just moves up in a series of uptrends and downtrends. And I don't want to oversimplify it, but that's pretty much it. You want to identify these larger trends as an investor or swing trader, or particularly a trend trader, and try to capture these uptrends. Now, we've been in a secular bull market for decades now, with cyclical bull markets and bear markets within there. In other words, this is a cyclical bear market with Boeing, and that also coincided with the 2007 to 2009 bear market, and what we call the Great Recession or the Great Bear Market. So we had a bear market back here. Right there, we had a bear market back here in the after the dot-com bubble burst, and you can see that we're getting pretty stretched in this bull market. This run has been one of the strongest runs in the history of the financial market. So again, let's drill down real quick and I'll show you the trend lines. So here's what's giving me a little pause. There's Boeing. Here's a weekly trend line, the uptrend line, and Boeing's still above trend. I think it'll probably roll over, but there's some work to be done. And then when we go down to a daily chart, you can see Boeing's dancing on this 317-ish support level. So once that goes, you can see the histogram over here, volume price histogram, pretty thin zone. I think it'll be a relatively swift drop down to that 268-ish area, which would be from where we're at now, a drop of about 17%. So again, I think it's worth doing this video, even if it's in advance and I'm not pulling the trigger yet on these. I want to share it with you guys in case you are long or want to and want to, protect, avoid giving back a lot of profits if you've been long these stocks for years, or even if you bought them recently, or if you want to short. Real quick to jump back to the ETFs, I checked. I didn't see any short ETFs, inverse ETFs for the sector. If anybody finds any, let me know, but I did a quick search. Not a very exhaustive search, but I didn't see any that popped up, at least on this charting platform. I'm not aware of any ETFs that will short the aerospace and defense sector. So that's Boeing. That's what needs to happen there to really get the ball rolling. As Boeing is the largest by far, this is now United Technologies with a market cap of $98 billion. So this one's half the size of Boeing. So watch Boeing. That'll give you a good idea where the sector is going. United Technologies has already rolled over, put in a divergent high here with a blow-off top. Remember, the market put in that blow-off top in January. A super strong run that really kicked off with the January lows in the broad market. But we also had a rally leading up to that through the month of December. This rally went from November. So this is quite indicative of a blow-off top. We had a sharp correction, a move back, failed to even match those previous highs, and the stock has since been selling off impulsively. It already sliced through its comparable level. I'm referring to the level I was just talking about on Boeing, coming up to the next support. I don't see a whole lot of support. There is a reaction low a little bit above that, so we'll call it a support zone about 116 down to about 114 or so. But that's a pretty ugly looking chart. And we go out to the weekly charts, and again, this shows you, very simple if you take a step back and you really focus on these longer term trends like I have here. And again, I'm just making the case for the corrections. This is a weekly chart, so this entire period starts back in 2009. So this was all throughout the bull market. That's why I don't have any downtrend lines drawn here. These were just, these earlier ones, I should say, were corrections within an ongoing bull market off the 2009 lows. And, they were considerable drops. I could measure them out for you. You can do the same on your charting program. If I grab the highs right there on that one, that was a drop of 32% right there. Being that we're so late in the cycle right now, and I'm talking about the economic cycle, the expansion that we've been in, one of the longest recoveries or economic expansions in history, the second longest bull market in history, which will soon be the longest in history if it continues much more. We're coming up on that record now. So what I'm getting at is, these were breakdowns of uptrend lines within a bull market. These were the early stages of the bull market, so the corrections weren't that severe. This last one was, as I just showed you, about 32%. Now, what happens when the final trend line is the final uptrend line within that larger cyclical bull market? Well, you get much more than a 32% quote-unquote correction. I know by the standard definition, they'll call a drop of 20% or more bear market. But remember, the stock market itself was in a bull market here. So individual stocks will move more so than the entire stock market. So call that what you want. Again, it's semantics, whether you want to say that was a bear market in UTX or just a correction within a larger bull market. And one would have to say, you just looking at this chart and the fact it went on to make new highs, you would say that's just a correction. So my point being is, if this is the final bull uptrend line break for this bull market, you're going to look for more than a 32% drop in UTX. And we go back and look at a monthly chart. Again, you can see going back to the early mid. Let's see, back here in the mid 80s, and then you had this, record bull market right here. You had a correction back here when the stock market corrected off that when the dot-com bubble burst, and it doesn't look like much because remember, guys, I use a log scaling, so the prices down here on the bottom are $4, and the price range at the top is 150. Log scaling is a must if you're new to trading or investing or charting. Don't look at a weekly or especially a monthly chart that spans decades using arithmetic or scaling. This is what it'll look like. The trend lines are different. The prices back here just look compressed. It renders a completely different picture because it's putting price moves in the same dollar increments. So when a stock goes from $10 to $20, it doubled. However, when it goes from $10 to $140, it's done a lot more than that, and that's where log scale will smooth it out. So log scaling shows you back here if the stock made a drop of, that was a 50% drop. Again, it doesn't look like much because it was early on using the log scaling, but then when I take it, measure it out here and move it up here, it will roughly equate to, it'll show you what a 50% drop looks like up here when prices are much higher. You can see on my pop-up box, that's about a 50% drop right there. Okay, so enough on that. That's just a little sidebar. And the important thing is when you're looking at these long-term trend lines, don't think, oh, well, back there it wasn't a big drop. If we get a 50% drop right now, it would look like this. We go from 120 down to 60. And that's going to be pretty ugly, and that'll take us down there. And again, I'm just saying that if we got that. I can add targets on these, and I'm more than glad if you're looking for individual names. But if not, we'll probably focus on the ETFs as the official trade ideas. I may add a couple of these as individual trade ideas. And then to wrap it up, we'll look at a couple more. Lockheed Martin, same story again. This is a monthly chart, spans back to the mid-90s. You see these uptrends, these bull markets defined by uptrends, trendline breaks, corrections, or bear markets. Bull market, trendline breaks. And the other thing, guys, that I really cannot impress enough is the fact that stocks tend to fall much faster than they rise, both during corrections and bear markets. And that's why I like to point these out in advance and give you a heads up. You can see, for example, back here, everything was hunky-dory as long as Lockheed Martin was above trend. And then it broke down. And you look at that candle. In fact, we'll zoom in here. And in 1 week, let me just try to grab around the top of the candle there to the bottom of the candle, and given it closed above there, this is a monthly chart, so that's 1 month, the stock dropped 33%, and you can see a near vertical descent, and then it continued to fall. So from the highs to the lows, that was a 52% bear market, wiped out 52%, or you can look at it this way, going all the way back to here. At this point, it wiped out right about here, all these gains. So it wiped out, I'm looking at my pop-up box left, 3.8 years. So almost, there it is, 3.8 years, almost 4 years of gains were wiped out in just a matter of 7 months. That is typical, and that is why you have to be quick, nimble. When we have increasing evidence that the market, a lot more trend lines have broken, the stock market may be in the early stages of a bear market or even a correction, you have to act quick. You cannot be a deer in the headlights, and you can't fall victim to that, oh, well, I'll just wait till it bounces back to blah, blah, blah. I've read a lot on this. I've been doing this for years. Before I was a trader, I was a stockbroker, investment advisor. It's human psychology, human nature. That's what happens during bear markets. When everything's great and during a bull market, you keep getting bailed out on the pullbacks, so you develop that mentality. And then when a bear market starts, the first stage is denial. Then once it becomes apparent, because the nature of the selling has changed, it's impulsive, people say, oh, well, now I'm down 30, 40% or 20, whatever that number is off the highs. I'll just wait till it gets back to blah, blah, blah. They want a 10% or a 15 or 20% kickback rally to get out. That never comes. The market will deny you that in a bear market. So at some point, you just have to recognize it for what it is. And, I'm always glad to show you levels where a stock may be coming up on support, and you may get a bear market rally or a bounce off that level. And I'm also glad to, and this is what I'll do, once I recognize that the trend is, we're now in a downtrend, I'll be looking for bounces back to resistance to short certain stocks, including some of these defense stocks. But you can see the divergences there. You can see the charts are ugly. Again, this is a monthly chart. If we go down to a weekly chart on Lockheed Martin, this one has broken trend. You can see that big red impulsive candle. Look at these last 2 weeks on these candles. They've engulfed, again, they've taken out from the highs on this candle to where we are today. And again, it's only Tuesday. This candle only represents 2 weeks of trading so far. This candle hasn't been finalized. It may turn around, we could backtest, or we could go a lot lower. Where I'm going with this is, if I take a line here, vertical line, we go back all the way to early August of 2017. So we've wiped out a year and a half of gains in Lockheed Martin now in just a week and a half, not even. And again, that is the nature of a correction, and it gets even uglier if this happens to be a bear market. And this is why I'm giving you all these trend lines. The more of these leading stocks that you see take out these key trend lines, the stronger the case is that they're not going to prove to be whipsaw signals. If just one of these top names breaks trend, okay, we still have others and they may find support. But when they all start to go, chances are there's going to be a lot more, because these are pretty significant trend lines. There's General Dynamics right on trend on a weekly chart. Monthly chart, you can see again, going back in time, trend line. This one broke down, back tested the trend line for a while, fell down. There is a very impulsive selling after trend line break, and here we are just starting to crack below trend. No reason to go much further. When we're down to General Dynamics, that's still a big company, $60.5 billion. I'm looking off the screen here. You know, we have Raytheon, another big one right under there at about 50, almost 59 billion, right at trend. So that's the story. I see consistency across the board. These are the components, and birds of a feather flock together. You can see the trend line there. You can see this red line below is a 40-week moving average. That's the same as a 200-day moving average, and it's done a pretty good job of defining the uptrends or the primary uptrends. You can see going back here, the stock would continue to find support on tests of that 40-week moving average. Then it broke below it, and we had a correction, a pretty sizable correction. Tried to regain it, fell again, and once we regained that trend line, you can see then it acted as support. So I love nothing more in trading than to have dual intersecting support levels to confirm a short entry. So in this case, we have both a moving average that has done a good job at defining support and resistance. Let me say that too. If you're new to trading or charting, just because everyone uses a 200-day or a 100-day or whatever moving average, whether it's a simple moving average or exponential, to me, it is absolutely useless if you're charting that security and you look back over time and the security that you're charting has traded through that moving average like it wasn't even there, like a hot knife through butter. It has no validity, no importance in technical analysis. So sometimes I'll even get on here if I see a moving average that it keeps getting breached, but it seems to hold support. Then I'll get around here and I'll play with the numbers. I'll start changing the periods on that moving average to maybe an odd number. A 40-week, like I said, is the same as a 200-day moving average because there's 5 days in a week, so 5 times 40 equals 200. But I'll play around with those numbers, and I can tell you it's not perfect, but it's done a pretty good job. So we'll wrap it up here. The daily charts, again, this one, it already cracked on the weekly, and it's cracking now on the daily. This is an impulsive break. So, you know, if you want to know my opinion, do I think you could short it here and you'd be okay if you give it a little room in case we get a kickback rally? Yes. And what I'm referring to, again, the 3 ETFs, if you like safety in numbers, it is earnings season, so all the more reason to use an ETF in lieu of individual stocks unless you've confirmed, and I imagine quite a few of these stocks have probably reported, because I'm looking at impulsive selling in the sector, which tells me a couple of the big names must have reported and the market didn't like what they see. I've not confirmed that, but again, the 3 are ITA, XAR, and PPA. You take your pick. Some brokers even give you free commission-free trades. They have paired up with certain ETF families. You might want to look into that. I think Fidelity does it. Ameritrade, if I'm not mistaken. I know Scottrade used to, and they were absorbed by Ameritrade. Schwab might do it. And even, believe it or not, Interactive Brokers does. I forget which family it is, but they have a family of or a long list of commission-free ETFs, although their commissions are so dirt cheap that it doesn't even matter. You can buy or sell ETFs for as little as $1 a trade. All right, we'll wrap it up here, guys. And if you are interested in some of these individual stocks or the ETFs and want some price targets, I'm going to work on that. I'm going to work on putting at least one of these out there as a short trade idea, and I'll list price targets. But don't hesitate to drop me a line in the trading room if you have any questions on these. All right, this has been Randy Finney with Right Side of the Chart. Have a great